folks, Scott here, and this is the wrap for Monday, July 29th. So you can see the cash market's already closed, or maybe you can't see that, but it's a little bit past 4 p.m. Eastern time, but the futures are still going. They go until 4:15, and you see the E-mini S&P 500 5-minute chart here with the past couple of days of action. So we put in an inside day today. Historical results with fading gaps after an inside day, a lower high and a higher low will show up in our daily worksheet in about 2 hours. Between 5:30 and 6 I'll get it posted. But going into tomorrow, what I thought would be interesting to show you was something we were discussing in the trading room this afternoon, and that is the difference between fading gaps following a large unfilled down gap versus fading gaps following a small unfilled down gap. I generally discount gaps that only miss filling by a point or less. Just to me, it's not a real big change of character, and that's what we had today. We only missed by 2 ticks today. In fact, I'll show you the high of the day. If you look here, it's right after the open, was 16. See if I can see it here. 1686 and a quarter. 1686 and a quarter. You see that long wick there, and the prior close was 1686.75. So it missed about 2 ticks. So let's first take a look at the results of fading gaps after a large or sizable unfilled down gap, and I've defined it to make it relevant. Gaps between 1 1/4 and 5 points. So missed filling the gap by between 1 1/4 and 5 points to the downside. Also including above the 200-day moving average. And there you go. So if you have a sizable unfilled down gap, then odds clearly show a downward bias, actually a propensity to gap up, but still a downward bias. Odds favor shorting an up gap and not buying a down gap when above the 200 after what I consider to be a gap that misses filling by a reasonable amount, 1 1/4 to 5 points. Now, we'll show you the results of fading gaps if it misses by 1 point or less. And there you go. So there's still a bias to gapping up, but the clear short bias or downside bias is no longer present. In fact, a gap up is just a neutral setup. In fact, let me double check something. Yes, I've got to be clear, this is assuming our MTG stop parameters. I meant to do that with an end of day stop, but it did not. Doesn't really matter because this is pretty much a dead neutral setup. What you'd look at, or I should say, this is what you would get if you tested, say, the past 2,000 gaps in the S&P 500. Very similar win rate and profitability. So just a dead neutral setup following a small unfilled down gap. And a gap down still shows a little bit of risk for buying a down gap, but yeah, I'd say it shows the same amount of risk, but you certainly don't have the bias or the preferred scenario of shorting an up gap. Now it's just neutral. So not a big difference, but it is important to point out some of these subtleties. And the key thing is a small down gap does not nearly represent the same change of character that a larger unfilled down gap would suggest. All right, let's take a look at what we had going into today. I'll show you our worksheet first, because we had some decent sized gaps to the downside. And in the worksheet, which was posted yesterday afternoon around 4 p.m. Eastern time, you can see a gap down between the close and the low. Between the close and the low is just a dead neutral setup. Not bad, not good. And we have one unique pattern to play, a bullish outside day. Basically an outside day that closes higher. That favored buying a down gap like we had today. But check out my... And for time's sake, I'm not going to show you these individual gap guides. They were just blah. Couple good ones, couple bad ones. The rest were just dead neutral. And in the video this weekend, let's see. I first talked about fading down gaps on Mondays after a 5-day low and above a 200. They've been 50-50. That's a little bit of a small sample size, but that is much worse using MTG stop parameters than what I showed in the video, which was 11 of 13 filled or finished positive. And today, it may squeak out a positive finish by a tick or two. It's right at it right now. But another unique pattern, in fact, this was in play on Friday as well, fading down gaps after 2 consecutive closes above the 10-day moving average after dipping below the 10-day moving average and still above the 200. That's a neutral setup, and if the gap is large, it's very weak, as Friday showed. And today, I think we opened we have been right at this level. So if you're even close, then you know you need to consider this. So for me, overall, just a neutral setup per the guides, some mixed data as I just showed you, and not a bad setup, but not compelling enough for me to risk my time and capital by entering at the open. So I passed on it, and it looked like I was going to be a miss, but it ended up rolling over and would have stopped me out. Now it depends on how I would have managed it and how you would have managed it, but it did not fill. It rolled over more than 6 points because the low today was 1676.50. The open was 82 and a quarter. The stop would have been 5 points today. So I avoided losing trade. Not real surprising. That's what happens on these setups that are just sort of neutral. They don't tend to fall apart, but they don't tend to work too well either. And the 15-minute and first hour range guys did not show any clear edges whatsoever. Low fade had some decent data. I did not trade it, and I think it would have stopped you out of both the 15-minute and first hour because we took some heat late morning. But quiet day for me, and we'll see what tomorrow brings us. And that is the wrap for Monday, July 29th.